So then basically, yeah, two more slides that we need to cover. Now we know that there are so many various relationships that the compliance officer needs to maintain or rather be focusing on, because his role is going back. He is the conduit between the management, basically the staff, and the regulator. So he is sitting in between. So whilst being in that position, so we discuss at length different types of relationships that we need to maintain. Then the question arises as to the potential conflict of interest that could arise in the CEO's role, the compliance officer's role, because the compliance officer owes duties to both the employer and the regulator, which can trigger conflicts at times. So this can happen because you are reporting to two lines. Just imagine, even in office, if you have two different bosses to report, so there are issues, right? At times in organizations also you find multiple reporting lines. I'm not referring to the compliance officer reporting to board and all, just in the ordinary business environment, at times it's not a very good practice anyway, but due to certain unexpected or rather unavoidable circumstances, there could be, I think some of you all may have faced this. When you have it's a saying, when you have too many bosses, it's very difficult to manage things. Like that, the compliance officer, not that he has too many bosses, but he has relationship with different parties, and especially the fact that he is sitting in the middle, connecting the regulator and the business or the bank, the management, the staff and all. So there can be conflict of interest that may arise in his. So CEO need to ensure that the organization acts in a compliant manner and avoid regulatory investigations, charges, fines, etc., and would also be under duty to refer matters of any misconduct to the regulator. Right? So in playing the regulator role, the compliance officer's role, his main duty is to make sure that the organization runs its business in a compliant manner. Right? So when in the process where he discharges his duties as a compliance officer, by ensuring that the business runs in a compliant manner, so in case, if there are issues, right, he may have to sometime bring it to the notice of the regulator. So that's why they say the CEO needs to ensure that the organization acts in a compliant manner and avoid regulatory investigation, right? So his job is to make sure that he avoids regulatory investigation, avoid regulatory breaches, right? Avoid possible fines and various other repercussions by getting the business to run in a compliant manner, right? But still, there can be instances where all these attempts fail, and there can be, somebody does something which triggers an investigation, a charge, right? Then he has a duty to refer such matters of misconduct to the regulator. He can't escape that responsibility as well. So on the other hand, CEO definitely is a party, the organization member. He's not his salary is not paid by the regulator. He's on the payroll of the bank or the financial institution, right? Then he has a duty to make sure that the business or the organization business also takes place, right? Now there's a saying in Sinhala, Leda Malat Bada Suddha. What does it mean? Right? You go to one extreme. So, you treat somebody, maybe, native treatment, right? So you give some treatment, but finally the patient dies, but the doctor's intention was to, clear the internal, the organs and things like that. So it's achieved, but the patient had died, right? So that type of a situation needs to be avoided. So you have to, as the compliance officer, make sure that the business is carried out, because ultimately It is the responsibility of the organization, the management, where compliance officer is part of it, needs to enhance the value of the stakeholders. In layman terms, we say you have to improve the profitability, improve your business, grow your balance sheet, right? So that is another responsibility casted on the compliance, right? So compliance has, while the duty to bring things to the notice of the regulator and getting the business to act in a compliant manner, he has also has a duty to make sure that he supports the business initiative, that the growth objectives are not put on hold, that the profitability initiatives are not put on hold, right? So therefore, he needs to provide necessary assistance and guidance to the business parties, the frontliners, right? To carry out the business in such a way that it is done in a compliant manner, right? Whilst meeting the growth objectives of the bank, right? So it's a balancing act. You got to balance these two. You are sitting in the middle. You got to harmonize the growth objectives with that of the regulatory requirement. Or put it the other way, you need to meet the regulatory requirement along with harmonizing with meeting the business and the growth objective, right? So in such environment, in the given environment, right? So it's very much possible. It's very much possible that there can be conflict of interest. So how do you manage this conflict of interest? Again, answer is go to the basics. Go to the basics, right? I think we discussed at length what and what we need to do, right, to get the people to buy, or rather buy them in to do business in a compliant manner, right? So why I say that you need to go to the basics is because you have to tell them, tell the business, tell the frontliners about the benefits that you can recover, benefits that you can derive by doing business in a compliant manner, right? The example, one example I think I took, probably you will remember, taking KYC is a regulatory requirement. Obtaining KYC is a regulatory requirement. But on the other hand, we very clearly understood, I think I explained it to you, the benefits of taking KYC, leaving the regulatory requirement outside. Did I discuss this? Can somebody answer, please?
Yes,
Did I
sir, we
discuss
did.
this? We did. We
Yes, we
discussed, right? So just take it as an example. Tell, give them the insights as to what benefits you can derive by doing business in a compliant manner. That is how you can buy them in. So KYC is all about knowing about your customer, right? So you have to tell that by knowing the customer, you are open to various business opportunities, right? You are widening the scope of your business. Out of, maybe 100 odd products that you have, you will exactly know which product to offer. What is the best product for this customer? How you can bundle your facilities? How you can structure your credit facilities? All this is, the KYC is important. Because sometimes a customer may come to you to obtain a loan. So he probably doesn't understand the banking, the format. He's just asking for a loan to facilitate an import or to facilitate an export. But probably he may not know that there are certain tailor-made import facilities, like the LC limits, sub-limits, right? Then maybe the DA limits, right? Then maybe the advising mechanisms. On the other hand, export, you have export credit, bill collection, packing credit. So different products, right? Customer may not know this. So he will come and ask for a loan, probably to service or to meet one of those requirements. But if you know his KYC, you will know, okay, he is an exporter. He is an exporter. Then with that knowledge, you will always divert your focus for export-related credit scheme. You know that he is an importer or he is a manufacturer, right? So you would know, by knowing the KYC, you would know which product to offer. So like that, anything for that matter, right? So you should be able to convince them. Other way of convincing is you can tell about the repercussions. In the short run, you may just grab a business, that's fine. But then what could be the repercussions? So if it is going to be funeral at the end of the day, so is it good to do that, taking all that risk? So then you can tell about the loss of confidence about the customer, from the customers on the bank, if that happens. And say, if you have been fined by the regulator for doing a wrong thing, what is the negative impact? These things can be made known to the people so that you can buy them in. So that's what I say, the compliance officer job role is extremely a difficult one, because there's an ample amount of balancing act involved in this process. So obviously there will be, and there are, conflict of interest situations that arise in the process of carrying out your business or rather your job role as a compliance officer. So you need to be very, very mindful of this fact that this is the nature of the job. There can be conflict of interest, and how do I sort them out? The simple answer is you got to tell both sides about the benefits and the repercussions if not met, right? From the regulator side also. On the other hand, sometimes you go and tell the regulator about the practical difficulties. Generally, the regulators will not listen to you, very simple like that. But I can quote example in my personal professional career where we have been able to convince the regulator on certain points and got certain concessions in meeting certain regulatory requirements. So that can happen. That is why you need to have the associations like the Association of Compliance Officers, where the entire industry will go in one voice and explain it, the practical side of it, right? So that's the role of compliance. And with that, I think we are finishing the lecture note 1, came up to that, and today we will start the new one, probably the lecture note 2, and see how we can engage in designing an internal compliance system for the bank. Right. Okay. Can you all see the screen now? Can you all see the screen?
Yes.
Right. I hope you have been furnished with these slides yesterday or day before. You all were provided with these slides, no? PowerPoint?
Yes, sir.
Has IBSL shared this with you all, no? Okay. So what I suggest is, right, you have 2 ways of doing it. Since we are on a virtual platform, I request and always strongly recommend you to make notes. If you can do it digitally on your computer itself by listening to our interactive sessions, you can make special comments noted there, or you can do it manually on another sheet of paper, or third option is you can get a printout of this and then probably make, whatever it is. So it's up to you, but making note of this session is going to be extremely important for you to get the full flavor of the subject, right? And also to answer your questions in a satisfactory manner, so that you would satisfy the examiner in answering your questions, because you need to bring all these facts that we designed, because ultimately we are going to test whether we are going to give a full quality product to the industry as a diplomat of the IBSL compliance program, right? So I'm repeatedly mentioning you and stressing the importance of taking notes, because everything what we discuss is not captured in the slide or the printout or whatever the PowerPoint presentation. Right. So now we are talking about the designing of an internal compliance system. Right. Now, designing of when you talk about the designing of the compliance system, right? So you need to take certain factors into consideration in designing the compliance system, right? So before designing an internal compliance system, it is important to identify internal and external factors that may impact the compliance system of a bank, right? So it is broadly classified into two segments: the internal factors and the external factors that need to be considered when you are engaging in designing a compliance system for the bank. Right. So let's see what are the external factors. So the external factors means, in other words, those are the regulatory regime. Right? In which type of a regulatory regime that you are doing your business in the bank, the regulatory regime. Right? So therefore, it will be important for the compliance officer to have a good knowledge and understanding about the regulatory requirements. Right? So you need to know the regulatory requirements under which your business is governed. When I say regulatory requirements, it's the full facet of the entire regulatory requirement needs to be clearly understood by the compliance officer. Right? So how do you keep your capital? What type of liquidity that you should maintain? Right? And how you should have your governance requirement, how you should have your AML CFT requirements, how you should have your credit requirements, how you should do your business in making the impairment as per the regulation, how do you do your disclosures, how do you manage your treasury, how do you manage your risk, how do you manage your internal audit function. Basically, there are regulatory regime, related party, right? Then, there can be exchange control, whole heap of, the entire full gamut of regulatory requirements are around you. That's we call the regulatory regime. And there are certain laws passed by the parliament from time to time, which gets connected to the regulation, right? So you need to have a very good knowledge of the regulatory regime, the regulatory requirements under which your business is governed, right? With that only, you will make your compliance system or the compliance policy. When I say the compliance system, it includes the compliance policy, then the compliance program, right? Then it includes all the compliance activities, right? So when I say the compliance system, it's a big picture within which the policies will fall in, the procedures will fall in, right? Then various other activities would fall in, the compliance program would fall in, right? All that will come in. It's not only that, remember, when you talk about the compliance, the system, that includes how the other activities within the organization also are being carried out, right? How the risk function is being done in the organization, to what extent it is done in a regulatory compliant manner. That is also part of compliance system, right? Compliance system is not only defined or confined to the compliance department or the division. No. We are talking about the compliance system of the entire bank. That's why I think when we are doing the governance, we will see I think even here, I think we discuss the relationship the compliance officer needs to maintain with the internal auditor, the relationship that he needs to maintain with the external auditors, the relationship the compliance need to maintain with business, with internal audit, so on and so forth. So compliance needs to ensure that all these things work in the given regulatory framework. The meaning of compliance is so wide that it will capture all these factors into that. So you need to make sure that when I say you, I'm only referring to the compliance department and the compliance officer, right? So compliance needs to ensure, the compliance function of the bank needs to ensure that it has this mechanism to look at the entire banking operation to see whether it's being done in a compliance manner. So that's the meaning of the compliance system that we are talking about, right? When it's being put into practice, I told you the policies will come in, the procedures will come in, the activities will come in, and the compliance programs will come in. You know, all that will fall within that. Right? So, having said that, we'll move on. You lost the screen, right?
Yes.
Yeah. Okay. So we are continuing on this. Following are some of the external factors which should be taken into account in determining the appropriate approach. Right. So we are now looking at the external factors. Right. These are some of the things that you need to focus. The regulatory environment and the objectives applicable to the jurisdiction. Right. So the regulatory requirements would vary from jurisdiction to jurisdiction. So you need to have a clear idea of as to what regulatory requirements are applicable to the jurisdiction in which you perform your duty. Now here there's another point that you need to keep it in mind when we are mentioning this, especially when you take the AML-CFT regime, right? Suppose if you have any business organization or your office or some kind of a business operation taking place in another jurisdiction, like Bank of Ceylon having a branch in London, UK. The commercial bank has various branches in other jurisdictions like Bangladesh, Vietnam, and all that, right? So, in such situations, especially when you are looking at from an AML point of view, AML requirements are you have to meet the regular requirements at the highest level out of the two, right? So there's a thing like that, just you keep that in mind, but it applies generally in the AML system where your regulatory requirements or your regulatory obligations would not only be confined to the regulatory requirement of your own jurisdiction, because if you have your sub-officers or the branch officers or different business operations in other jurisdictions or in other countries, especially on a AML-CFT note, you need to make the comply with the jurisdiction of whatever the has a higher requirement. So that's generally an exception there. So the regulatory model adopted by the jurisdiction and the regulator. The model adopted by the jurisdiction and the regulator. What kind of a regulatory model is being adopted? Then obviously you need to have an idea of as to what the powers of the regulator are. What powers the regulator exercise? Right? Now in Sri Lanka, there are certain violations. The regulator has the power to levy you fine. In certain instances, it is defined what the fine could be. Right? So you need to know what powers the regulator has. How the regulator can enforce the regulatory requirements on you. So with that, what are the implications you are going to face if those are not met and the regulator has power so that you can be reprimand or fine or, put into difficult conditions, right? So the powers of the regulator. Then the regulatory principles and the detailed rules suggest, right? What are the regulatory principles? What are the regulatory rules? Like the basics. When you do your business, it is regulatory as well as ethical requirement that you need to conduct your business with integrity. Right? That's the saying. The banker always has to act in good faith and without negligence. Right? Without negligence part comes in at times, but acting in good faith is a must that every banker has to practice at every level, at every point, for everything. Right? Doesn't mean or doesn't say that you can act in good faith, but you can always act in with negligence. No. General requirement is you have to act in good faith and without negligence. If you talk about the Bills of Exchange Ordinance, you will see there are certain sections where the bankers are given protection. Example, Section 82 of the Bill of Exchange Ordinance, where the collecting banker is given protection against the delict of conversion. The different subject, right? I'm just taking an example, right? So, now in order to get that, right, you need to do certain things. Within that, under some of those, I'm not taking time to go through that. If you have done your banking, you would know. You have studied your Bill of Exchange, right, ordinance and the related requirements. You will remember Section 82 tells, as a collection banker, you need to fulfill certain conditions to get the protection or conversion towards the true owner of a check, where you have to act with certain other things. It has to be a cross-check, it has to be the action has to be taken in the ordinary course of business. Then it has to be the holder for value, and the banker has to act in good faith and without negligence. That have been coupled in there, right? So if it can be proved that the banker has acted maybe in good faith, but has acted with negligence, then you are losing the protection, right? So I just took an example where the good faith and acting in good faith and without negligence has been made part of the law. But in general, you have to act in definitely in good faith in all the time. Good faith means, in other words, act honestly. Act honestly, right? So, under the regular requirements, under those principles, one important thing is to conduct the business with an integrity. Right? So you have to maintain high level of integrity in doing your business. Be managed by individuals with appropriate skills and competency. Right. Now, that is why the fit and proper requirements have been built into the as a regulation. Right? You know, especially the top level, the corporate management. When they are being appointed, their fit and proper assessment needs to be done. In other words, the central bank will make a call. You need to write to central bank, the bank supervision department. If it's a non-bank, you have to write to the non-bank supervision department and get their approval prior to the appointment by presenting the credentials of that appointee. So the central bank will give approval to say, okay, he is fit and proper to carry out this job. So it's one of those important regulatory principle that you have to follow. That's why it has been brought in. When the business is going to be managed by people and individuals, you have to assess their appropriate skills and also the knowledge and the competencies to see that whether they are fit enough to carry out that process. Right? Then you have to always keep in mind that the customer is the king. So you have to have the highest regard for its customers, right? What do you mean by having the highest regard for its customers? Customers' money is being kept with us on the understanding that it will be paid to them on demand when they want it back. So you need to always keep in mind that the highest regard is given to your customer. If not, customer confidence will lose, because it is the customer's deposits that you are using to make money to roll out your business activities. So therefore, you need to have very high level of regard for your customers, and his needs need to be duly addressed, right? Then there are certain special regulatory requirements which have been incorporated or have been put into practice by way of the customer charter. Non-banks, you have the customer protection direction. So same thing basically. So it safeguards the rights of the customer as well as it safeguards the rights of the bank also. But if you analyze the customer protection or the customer charter, right? If I remember right, so direction number 8 of 2011. Not very sure of the number, but you can go back. So it tells what obligations you have towards the customer. Mostly, if you take it, I think it's about 75% of the direction talks about the banker's obligation towards the customer. Of course, it talks about the other way around also. The customer also has certain duties to fulfill towards the bank. But that tells the importance of the high regard that you need to maintain for the customer in order to have a well-run, compliant system within the banking operation. Right. Then you need to organize and control its affairs effectively as compliance officer. How do you do this? It's easy to say. Organize and control its affairs effectively. Right? Can somebody answer me? Because I want to provoke your thoughts. Otherwise, this looks very simple when you see this. But what is important is every point what we discuss here has lots of deep meaning. You need to get to the root of it. If you are to put this into practice, passing the examination is one side. I think it's more important to put these concepts into practice in order to have a better compliance in our organization or in the banking industry. So can somebody please tell me, what do you mean by, or how can you put this, organize and control its affairs effectively? I would need some feedback from you, because I just want the interaction and for you all to think about it. Is my question clear? In simple, I'm asking, now we are discussing about the factors to be taken into account in designing the compliance system. Okay. So we are the compliance community. Now it is say, this is what one of the textbooks say, right? To organize, when the one of the among the factors to be taken into account, it says you have to ensure the organize and control its affairs effectively. It means the bank's affairs. How do you do as a compliance officer? So there can be a question. The question can be this. When designing a compliance system for the bank, right? The compliance officers need to ensure that he, she, or the compliance function organizes. Compliance function organizes and controls the affairs of the bank. That can be the question. Please explain. Right? 20 marks question. So I'm training you for that. What could be your answer? Yeah, please add. How do you do this? Somebody can make an attempt. It's okay. There no 100% correct answer you can give in one shot.
So have a proper internal control mechanism working along with the compliance structure.
Yeah, very good. That's one point. What's your name?
I'm Sandhani from Asset Line Capital.
All right. Good, Sandhani. It's a good answer. So others can add flesh to this skeleton. Right. So what Sandhani says is you need to have a very well articulated control systems within the bank. Right. The point that we are saying is more or less the same. Right. How do you do this? Okay, Sandhani gave some input to that. So how do you ensure that the bank has good, robust, effective control system within? We have discussed this. That's why I'm putting this question to you. Because this program, if I don't have to do this lecture note given. One might say, okay, you can just go through. If it's a O-level like exam, you can just ask very straightforward questions and you can learn this by heart and come and answer. It's not that definite. It's not that. The contents here, that's why we are discussing these things in detail, for you to get to the insights of the issue. How you put this into practice. Because the Institute of Bankers are focusing on putting good quality, operationally efficient people to the market. So our idea is also that through this program. So how do you do that, Sandali? Or maybe others? So how do you do that? That's just one aspect. Yes.
We should have a good monitoring system
Monitoring
that
system.
covering, yeah, that covering 365 angle monitoring system.
Yeah.
Whether that these processes and the procedures which have been placed and communicated are continuously followed by the relevant departments.
Right. So this is Mano speaking, right?
Yes, yes.
Right. Yeah. So correct. So you have to have a monitoring system. So how do you have the monitoring system? Now we are developing the answer. How do you have the monitoring system? Now, Sandhani said, okay, we need to have effective control system. So obviously you need the control system to organize and control this affair. Now Mano says, okay, we have to have, good monitoring mechanism. Right. So others, so even the
Formulate
very,
appropriate policies and procedures.
come again?
Formulate appropriate policies and procedures in line with the regulations.
Yes. What's your name?
Randilu.
Randilu. Yeah. You are right, Randilu. So that's right. You have to have the policies and procedures. This is what we discuss. You need to have the policies and procedures. So if you can segregate and then give different separate focus on having policies and having procedures too. When you say, policies and procedures, it goes hand in hand and goes together. But when you put into practice, what you need to understand is, yes, you have to have the policy. Then the procedures are there to meet the policy requirements. That's very important. Now, sometimes we don't know why the procedures are there, but if you really analyze, you will see the procedures are formulated, or it can be the duly formulated, or it can be the time-tested ones where the banking industry, has developed over a period, right? We're taking various regulations, various laws into consideration. So you have to have the procedures in order to ultimately to meet the policy requirement. Right. So I think now we have formed the answer, basically. That is how you have to do. I think we discussed this, right? So having the policy, getting the board approval. So this is how you can add flesh to this. Because it's a 30 minutes, 35 minutes question. Examiner is going to test your comprehensive, whether you have comprehensive knowledge and putting these things into practice. Because when you get to your desk, to do the compliance function, you're not going to refer this note. How to do the compliance function, unless it's a very specific one, like, doing a compliance matrix and things, you may refer. But then still, what is required is you go out with a very augmented mindset and having your basics and then the fundamentals and the concepts as your, the weapons around you to fight the game. Right? That is the product that we want to put out to the market. That's why I'm taking time to train you in this thinking pattern. Right? So, having policies, the policies are there taking the regulatory requirement, the external requirement, right? And then having procedures to run it, and also getting the board approval so that it becomes the authorized and the endorsed policy of the bank. And then you put the procedures and have various owners for the procedures. That's where the control, that monitoring part comes in, right? And keep on monitoring. And then probably you have to have your follow-up checks by way of compliance checks or the compliance audit, whatever the way that you may call it, by way of carrying out regular internal audits with a sound internal audit program in place. So this is all compliance. Compliance system cannot be in place without the support and the involvement of the other stakeholders. So you need to take it in that spirit, right? So whether the audit program is comprehensive enough is part of it, monitoring. And once the program is formulated, whether it's being implemented properly, according to the time schedule, that's also monitored. Right? So I think you got the flavor of it. So when designing the compliance system, all these are going to be part and parcel of the compliance system of the bank. So that's why I say compliance is the job of everybody. Go to the basics, always relate to the basics. Compliance cannot be done only by compliance department or the compliance officer. So it is a responsibility of the entire staff of the bank to do business in a compliant manner. Of course, you have to have your organized things. And the word organized comes into play. You have to have things organized and have the controls and have the mechanism to run this business in that way so that it would help you, or it would facilitate a proper, well-articulated, effective compliance system within the bank. Got it? So you might get a question like that, right? So then this is how you have to answer. And in the process, I'm giving you little, insights as to how to write the answer. You frame your answer, take the question, frame your answer, and just jot down your points, and then start writing. Right? So you have 5 questions to answer, and given about 180 minutes. Right? So you have basically, it's about 35 minutes for a question. Right? Then 5 minutes you can take to read the question, and then jot down how you are going to formulate your answer, the points. Then you can expand on it. Right? That's how you need to address. So when the question is taken, you need to understand what is that the examiner is trying to test you. Because in most of the questions that I have experienced during the last couple of years, because these things, look very common. I mean, say you can bring anything and connect to anything in this, especially this subject. But you have to read the question very clearly and try to understand what exactly the examiner is trying to test you on. And you need to give the answer to that. And some people write, pages, 5, 6, 7 pages. But, you go through the paper and you hardly any creamy point that you can find where a mark can be given. You just write essays, right? I mean, so when you go through this program, you have vocabulary, you have the content, and then you can write. But it's important in the examination that what you write needs to answer the question, right? First, you need to, and say, okay, this is, then other ways when you're answering, right? Try to write legible letters. So it happens because you don't write much. In the examination, you try to write, right? Sometimes your handwriting may not be clearly read by the exam. So you need to be mindful of that also, because these are the problems we are encountering or experiencing while going through the scripts, right? So you need to put it in such a way that your cream of your point you can underline. Then the examiner's focus goes into it, right? So examiner's focus goes into it when you underline your the important part of your answer, right? So A, you need to understand the question. B, you need to just formulate your question by jotting down your points that you are going to expand, and then you present it. Please do write legibly, right? The examination center, they are going to give you papers enough. They are not going to write your answer only in 2 pages or 1 page. So take the pages, number them properly, right? And underline the key facts so the examiner's focus will automatically go into it, and then you will score marks. Although when you start writing essays without relating to it, examiners struggle to see how best you can give a mark, right? You have to go through it from top to bottom, then you get, really frustrated. Don't do that, because your idea is to satisfy the examiner and pass your examination. So I'm just giving you little points as we go on so that you would follow the lectures, keeping those things in mind. So you are, continuously being prepared, A, to come out as a better product to the market. That's the important most for me. Obviously, number 2, from your point, is extremely important for you to pass the examination, right? Having both these objectives in mind, so you need to prepare now itself. Keep on preparing, so then you don't have to break your head and then get stressed and all that, right? As the following the lectures are so important, that's what I am repeatedly saying, and invite your others who are not following it to listen to the program now. Of course, at least probably I think you all are having a recording, right? You can listen to it even later, but it's nothing like listening to it on live and querying what you have, the doubts and all that, then and there, then you can go on, right? So the simple, very small sentence, organize and control these affairs effectively. See how, to what extent you can augment this, and what a lot of meaning is there in this, 5-6 worded sentence in this. So you need to understand this. Then only you will put that into practice. Then obviously you've got to be open and transparent in whatever you do, right? It's not only compliance. Everybody within the bank needs to be open and transparent. You can't do something and tell something and do something else. That's wrong, right? So you have to be open and transparent, especially in doing your business. Then next important thing, you need to have adequate resources. You have to have adequate resources, especially in compliance and in other areas also. If you don't have the resources properly, then the chances are there that you will compromise the quality of the work. But at the same time, please do understand, the banks are very cost conscious now. They don't give excess staff. You don't have to, because that's the cost. Every center is being, taken as a, profit center or a cost center, right? the departments like compliance are cost centers. In that case, you need to manage your cost or reduce your cost. Or if you have to improve your cost, it has to be for value. So that's the proposition, right? You say save, cost controls. So all these are part of compliance, right? I'm discussing. Cost control doesn't mean that you're going to, reduce all your expenditure. Yes, you have to reduce expenditure. But at the same time, you need to spend. You need to make expenditures. For what? To create value. Every cent or penny that you spend needs to bring some value into the organization. There has to be value creation. So that's the management today. You need to create value for the organization. You need to create value for the compliance. You need to create value for your department. You need to create value for yourself in whatever you do. Right? Why you are sacrificing the first half of Sunday? Not only to pass the examination. Ultimately, it has to be to add value to yourself. By that, you would add value to the organization. By that, you would add value to your compliance function. By that, you would add value to the bank. By that, you would add value to the industry. By that, you would add value to the economy. By that, you would add value to your country. So it's that. So resources are required. That's important. Compliance is a costly affair. The banks need to understand this, right? Now I remember, the good old days, right? People, these are facts. Somebody is not doing things properly, they are being dumped in the inter-audit department, right? That's a wrong approach. This is such an important department. The discarded people, that's not a dumping ground for the discarded people. Shouldn't be the case. But now things have changed a lot. I know. All the expertise, the people with expertise, having experts, or the experts having the expert knowledge are being taken into this department. That is because it's playing a very important role. So likewise, you have to have adequate resources to do business, to do business in a compliant manner. So those are important things that you have to keep in mind in designing the compliance system. Then adequate and effective risk management system, extremely important. I think one of you all brought that control as a point when I asked the first answer to organize and control this affair. So these are part and parcel of it. You have to have a very effective risk management system within the organization. So when you are doing governance and role of risk, we will discuss this in detail. So I will not touch on it. So if I don't do that, I will touch on it. So you can ask. So I'm not going to expand on this at this moment, right? For the time being, you have to have a proper risk system, the proper risk program, then the proper risk matrices, then the very well articulated the risk appetite, risk policies. So with that only, you will have an adequate, effective risk management system within the bank. Now, what are we discussing? To have two factors to be taken into account in designing a compliance system. Here we are talking about the risk also. So it's part and parcel of the game. You cannot take things in isolation and say, this is risk, this is compliance. No, when you say compliance, it entails the entire operation of the bank, including risk, audit, business, and so on and so forth. Maintain systems and procedures to prevent financial crime, directly focusing on the AML regime. So in a compliance system, so much importance given to the AML, CFT. Maintain systems and procedures to prevent financial crime. So those who are in compliance would know how much of focus that you need to give to this very important area, AML, CFT. Because if you fail to do that, repercussions are extremely serious. Extremely serious. There can be fines, corporate fines, personal fines. Would have learned this. There can be personal fines and personal implications. You can be sent to jail if you violate the MLCFT law for a period between 5 to 20 years. And there can be fines on you, personal fines, which can get extended up to your personal assets. The bank can be fined at times not exceeding 3 times of the sum involved. Suppose you need to do a fortnight report of the transactions of 1 million and above. CTR, EFT in, EFT out, electronic fund transfers, inflows, outflows, and the cash transaction. This is the AML regime. So you need to have a good system there. Suppose if you fail to report a particular transaction, say a 50 million transaction has been dropped in the report, and on a subsequent inquiry, because central bank, the FIU has a huge database, which is formed by having information from all banks. So sometimes I think if you are in compliance, you would notice that central bank sometimes say, okay, let us know the type of account that you have with this customer, details of the account you maintain with this customer. So it can be something that has triggered somewhere else, but when you are giving the information, of course, it will come onto their radar, right? And in any of those, they are frequently in an internal examination, it's found that certain transactions not been reported. You can be fined 3 times of the value of the omission of that transaction. So if it is 5 million, you will be fined 15 million. Just a mere letter, that's it, you have to pay. Right? So that's why it said, maintain systems and procedures to prevent financial crime. Financial crimes are probably the predicate offenses under AML. The PMLA talks about certain predicate offenses as financial crime. Right? So basically, when you are designing a compliance system, you have to pay special focus on it because the repercussions are extremely serious. If you fail in any of those, then the deal with the regulator in an open and cooperative manner. Right? This is another area that you have to keep in mind. You need to deal with the regulator in an open and a cooperative manner. 2 things. Your dealings with the regulator is something that you need to take into account when you are designing a compliance system, how you are going to deal it. So you need to have your internal processes or rather the passion to do it that way. Otherwise, your compliance system is going to be weakened, right? So you have to deal with the regulator in an open manner. I mean, you can't be hiding things for the regulator. And in a transparent manner. In a cooperative manner, you have to cooperate with the regulator, right? So that's why I say the regulators always need to be, very well managed. You can't dictate terms on them. So you need to have that relationship in such a way that you manage the regulator properly, right? So now you would have got a fair idea of as to what external factors that you have to keep in mind or have in the back of your mind or have in your focus or radar when you are designing a compliance system for the bank in terms of external factors. Now we are moving into the other pole, where are the internal factors, right? So the nature of the compliance system will depend on number of internal factors such as A, risk appetite of the bank. I mentioned this. What is the appetite of the bank in taking a particular risk? I told you in the session, banking is all about taking risk. If you are not prepared to take risk, banking is not the business or the profession for you. Right? Including a cashback facility, granting a cashback facility and granting a billion worth of project loan or tying up with a foreign agency as far as the transferring and investment of funds are concerned. Right. Everything there is a risk. Opening of an account, there is a risk. Closing an account also there is a risk. If you don't do it properly. Right? So whatever you do, you tell me anything, or you think of any function, anything within the bank, you will see that there's an underlying risk related to it. Nothing you can say that risk-free. No. That's what I tell the way. Granting a cashback loan, also there is a risk. If it's not done properly. Risk is very, very low. Very, very low. But there is a risk. We need to manage that. Right? So the risk appetite is, there is a statement called the risk appetite statement, approved by the board, remember, probably through the BIRMC. And it has to be like a policy, a document that needs to be approved by board, where it will very clearly stipulate as to what is the level of risk that you would take in different, business verticals and the process verticals and the maybe different lines. Right? What is the risk we can take in granting a facility to a particular sector? What is the, so it has to be always maintained within that given risk tolerance. Any deviations needs to be brought to the notice of the management by the CRO and then to the board also. Right? So, do you have any idea of as to what this risk appetite document is? Right? So I can just, just run through and then finish it off. But you need to have an understanding. If not, I suggest when you go back to your stations, banks, try and get an understanding about what this risk appetite document is. That will give you a full insights into this game. Right? Starting from the, what is the risk you are going to take on certain products? What is the risk you are going to granting facilities to a particular customer, single borrower? Group level risk. Exposure to a particular industry segment. Right? Then the interest rate risk that you are going to take. If you are into pawning, what is the tolerance on a pawning advance of say a particular carriage? Right? What risk can we take? The people who are doing gold loans, not pawning. What is the risk appetite that you have in granting a loan on a 1 month basis, 2 months basis, 3 months basis, 6 months basis? Like that, you will have various risk tolerances. Your NPA. What is the appetite of the bank where the NPA is going to vary? Right? The capital adequacy, risk appetite. What is the risk that we can take? Now, the regulatory requirement says you need to meet X percentage. The risk appetite can be X plus, say, 50 basis points. Right? So that's the risk appetite. The bank is not prepared to take a risk, though we'll say the capital adequacy you have to have at, say, 10%. Right? So tier 1, say 5%. That is a regular requirement. But you will have your risk appetite to say capital adequacy. We don't want to take that risk where the capital adequacy come down to more than 5.5. You always keep a buffer. So different banks can have different, that's up to the bank and the board to decide. Depending on your, the credentials, depending on your capabilities, depending on your capacities, right? All that. So what I'm trying to say is there's a document called the risk appetite. So when you are designing the compliance program or the system, not the program, compliance system, this is one important thing that you have to have in mind, risk appetite of the bank. The nature of business, the diversity of operation, nature of business, what type of business in which that we are engaged in. Right? If you are doing gold loans, that's part of the nature of the business. So you need to have a clear idea of as to how the gold prices would vary in the market, world market. Highly vulnerable business, very profitable, but highly vulnerable. You need to have your risk controls very clearly focused on the business operation, nature of business, right? And are we into pawning? Are we into leasing? Are we into factoring? Are we into hire purchase? Right? Diversity of business. Where you would diverse. Are you into standard banking business? Or are we going to give, additional, the consultancy services? Where it could be going as part and parcel of development banking. Where you provide additional service, the diversity of business operation. And sometimes you will have a business operation in another foreign jurisdiction, probably running a micro arm in Bangladesh, probably running a SME arm in India. The diversity of business operation, complexity of the business. What type of complex product do we have in the system? Or are we only confined to our conventional type of banking, or have we opened up? That's the order of the day. You have to have digital banking. You may call phone banking, right? You may call it internet banking. You may call it, various, payment channels, the remittances, right? So that's the complexity of business. When your business model is going to be complex by putting out various e-platform, which is the order of the day. I mean, if you are not giving that, you will be isolated, and I don't think you can be competitive in the market, right? The threats that you get from the outside, fintechs, the finance companies, the fintech, these people are, those are the threats to you. And the payments can be done each and everywhere, right? So the business is becoming more and more complex. The diversity is, getting further expanded. The nature of business can vary based on, what you are offering to your customers. And according to the scale of the business, that would also vary from bank to bank. What's the scale? What is our standard ticket size, loan ticket size in this product? Which scale are we doing business? Right? Do we have capacity to grant a loan of $1 billion? That scale loans, are we having the capacity, or have we got to go for syndicate loan? When you are, granting such huge loans to the market, right? The scale of its business. At what scale are we operating our business? And the volume of transactions. What are the number of transactions that we have? The volumes is very important. If the volumes are less, you can still do a certain manual check on it. But if the volumes are so high, then the manual checks will not work. Of course, today the manual checks are not very encouraged. One thing is more time consuming. The other way, it's exactly not effective, right? But the volume of transactions is another important thing that you need to have in mind in designing the compliance system, because if you are not having a focus on it, good example, so you are buying a particular system, of course you need to have an idea of the size of the value of the transaction volume. What is the volume? You are not going to buy a system to take it and then throw it tomorrow. Probably you are going to use that system for at least for a good 5 years, unless and until you go in for a higher version of it. So you need to predict your the transaction volume, what it is going to be in year 1, year 2, year 3, year 4, year 5, something like that. Right? So when you are designing your compliance system, you need to have a focus and idea of as to what the volume of transactions are also. Right? Now we discuss in detail what are the factors, external, internal, that you need to have in mind in designing a compliance system. Right? So once you design the compliance system, then it is up to the different stakeholders who are parties to that compliance or parties playing within the compliance system, not necessarily be in the department itself. Right? They will be out of your department, but having that compliance system covering the entire operation of the organization will be the key responsibility of the compliance officer. That's why you have to maintain your relationship with others and get them also to do things properly in the compliant manner. So that's it. Right. Now we are moving on to developing compliance policies and obtaining the board commitment. Right. Now we discuss in detail generally about the policies of the bank, especially the compliance policies, why it is important. The following most recent financial crisis, it's not most recent now, this happened more than a decade ago, right? The world financial crisis. The financial industry felt the importance of effective risk management as a key to avoid widespread systemic problems. Right. Now, if you go to the roots of the financial crisis that we saw the decade before, we will try and learn these things when you do governance in detail, right? The giants, the financial giants fell, right? What were the reasons? What were the reasons? We will study them in detail when you go into governance model, right? But just as a kind of a introductory remark to this session we are discussing now, they failed because they didn't have proper systems and controls. Right? The last financial crisis, we in general, we term it as a subprime crisis. Right? Subprime crisis. So what happened is the major reason was the loans that were granted was there were debt securitization and they have given loans on one on top of the other. Right? And the facilities were granted without looking at the capacity of the borrowers. Right? As a result, and also coupled with the fact that there had been, extravagant salaries and the perks enjoyed by the top management, having a very luxury cushy life, getting highly paid salaries, right? Ultimately, it was a question of just growing the balance sheet and showing certain book profit and expanding the operations for the sake of doing it and to be seen by the outside world, but creating a hollow effect within the organization. And ultimately, loans could not be paid by the borrowers because they had been dumped loans beyond their capacity. So they have happily been taking certain mortgages. The mortgages have been remortgaged, right? So these are the incidents. Ultimately, the entire system collapsed overnight, right? And there's another important concept there called the contagion effect in the banking industry. Due to this high, contingency effect that you find in the industry of banking or in the financial sector, especially in the industry of banking, it got spreaded very fast to the other part of the other organization and other part of the world also. The financial crisis which triggered in the US and in the Europe triggered in such a way that it went and put the entire banking system in the Gulf also down very drastically, mainly due to this contagion effect. Contagion effect is there in most cases, but we say the contagion effect is extremely high in the industry of banking. What we mean by the contagion effect is this industry is knitted together, well connected together on various business transactions. It could be investments, it could be various refinances granted, it could be various borrowings, it could be various, the deposits, investments with different banks. If you study this, even the Sri Lankan banking structure, right? There are banks who are owned by various other banks, right? So there are ownership of certain banks by another bank. Investment. They have invested. So this is very common here, even in Sri Lanka. I don't want to go into details. If you go to the annual reports and you will see different banks have ownership by another different bank. Right? So in such a situation, if one bank fails, obviously that will affect the other bank who has an investment or who has given a borrowing, made a borrowing, or who has made a deposit with them. Right? So these are interconnected. That's why we say the banking industry, the contagion effect is high. So as a result, any failure in any of the bank in the world can affect the banking system as a whole. Right? Then those are called systemic problems. There are systemic problems within the bank. There can be systemic problems, in the industry. The problem that relates to the system are called systemic problems. Right? So the fact that the financial crisis made such an adverse impact on the world, right? The financial sector, the people who are, interested in this, that's how the Basel Committee was formed. Right? That's probably the reason how these regulations, the governance regulations came into effect, especially after this, which made certain board concept, the fit and proper concept, the composition of the board, having various upper limits for the serving directors, age barriers, the period barriers, and all that came into effect or intensified after the financial crisis triggered. So the financial industry felt the importance of effective risk management as a key to avoid widespread systemic problems. So although the managing such risk is main responsibility of the board, they rely upon the compliance officer in designing and implementing the internal compliance risk control framework. Right. Now, part of these things we have discussed in our previous lectures. Right. So the importance of risk management is very much obvious now. So the managing that risk, the main responsibility lies with the board because they are the policy makers for the bank. Right? So the board is responsible to make the policies for the bank. When I say make, board is not going to sit and draft the policy. It doesn't happen. Somebody down the line drafts the policy and it has to be reviewed by the board and approved by the board, that it becomes their document. That is how it works in practice. The board can always advise by going through the draft, okay, bring this control, bring this into this, delete this, go and amend this. So they are supposed to go through it and probably at the various subcommittee level in detail perusals, screening needs to take place, and thereafter it has to be approved by the board. Once it is approved by the board becomes the owner of the principal owner of the policy, right? Or the main person who is responsible for that. But in order to do this, they rely upon the compliance officer on designing and implementing the internal control. Right? So what does it mean? What do they expect? What do they expect? They want the compliance to design and implement the internal compliance risk control framework. So what are we talking here now? How do you design and implement the internal compliance risk control framework? That is probably, you can think of your compliance program. Compliance program for the year. Right? That could be the main document with which you would give that comfort to the board as to how you would ensure that the compliance, the internal compliance risk, what is compliance risk then going back? Compliance risk is regulatory and legal risk, right? So in the compliance risk, finally, it can be, it boiled down to regulatory and legal risk. So if there's a regulatory issue, or it can be a legal issue by not being compliant, right? Then it will lead to various other repercussions like financial losses, reputation losses, and many other consequences. So that's how the link works, right? So the board would rely on the compliance officer on designing and implementing the internal compliance risk control framework, right? So in designing the high level of compliance risk mitigating framework, the following factors need to be considered. Identify the strategic objectives of the business. So in a lockdown period, so you get these noises, right? Okay. Right. Now, have you understood up to this point? Is it clear? I haven't heard from you for some time now.
Yes, sir.
Right. How about others? Are you clear? We are talking in detail, right? Have you, because my understanding, my requirement is, objective is to give you the full gamut of it so that you would understand it and you will go out. When you are practicing, you understand how this system works and whether we are doing enough in compliance or whether there is anything more that we need to do in compliance. How best we can improve this within the organization. Where have we fallen short? All this. Right. Others? Others are intact or have they dropped?
Okay, fine, sir.
We've understood, sir.
Okay.
Yeah, it's okay.
Right. Thank you. So in designing the high level of compliance risk mitigating framework, the following factors need to be considered. Identify the strategic objectives of the business. Identify the activities of business such as production services. Identify the rules and regulations to be complied by business. Determine the risk appetite of the business. Identify compliance risks faced by business and how they could be ranked in order of the severity. Now the first bullet, identify the strategic objectives of the business. Extremely important. The business strategy of the bank needs to be known by every corporate member of the bank. But they need to know the vision. They need to know in which direction the bank is moving. I use the word bank, and then if somebody is from a financial institution, you can relate it to your own, right? For the easy presentation, I mean, much used to it, so I use the bank, right? It applies to the FIs as well, right? So it's important to know the direction of the bank. What is the strategy? Strategy can be designed or rather defined into three segments mainly: short-term strategy, medium-term strategy, and the long-term strategy. Compliance has to have an idea of as to what the strategy is. What's your short-term strategy? What is your medium-term strategy? What is your long-term strategy? Now, for instance, now these days, I think there are lots of focus given on moratorium. How to reschedule facilities, how to grant moratorium. And it has become a regular requirement also to give moratorium. Various moratoriums are coming, one on top of the other. Extremely difficult situation for bankers now. So the compliance needs to understand what are the moratoriums that have been specified by the regulator. Short term. So it probably would have been in the strategy of the bank. Maybe your NPLs have, gone up. Right? So there can be certain focus strategy, short-term strategy, falling within the macro strategy. The short-term strategies can vary. I mean, strategy is not a thing that's going to be carved in a stone. These are going to change and evolve from. Yeah, these are going to change and evolve from time to time. Once you craft a, formulate a strategy doesn't mean it's something that you have carved in a stone and it can never change. No, it will change. It has to change. But it can't go and change drastically if the strategy is proper. That's why you have short-term strategies. In order to meet the long-term strategy, you need to have medium-term strategy in order to meet the long-term strategy. So there can be variations and changes taking place in the strategy, the short-term strategy especially. Right? Like you have your planned activities and unplanned activities. Remember, compliance, when we discussed compliance activities, twofold: planned activity and unplanned or ad hoc, which can arise from time to time, but still you have to do without compromising the planned activity. So likewise, the strategy, you will have probably many changes coming in the short-term strategy. Compliance need to understand this. Today's environment, yes, moratorium is the order of the day. That's the buzzword. Everybody talking about moratorium, debt moratorium. You need to understand what a moratorium is. You need to understand what a reschedulement is. That's again that my example comes into play. A consultant physician, compliance has to be so he needs to understand this business logic and the business game. Otherwise, he will be lost. You cannot guide the business. You need to know your onions in credit. Then only you understand what this moratorium is all about. Then you need to understand if the moratoriums are granted, if the facilities are not recovered on the given date, what could be the repercussion? It will immediately come and hit you as a flash hit. So once you grant the moratorium, you have to have a very close, I'm just talking about the practical side of it, close follow-up, so that you're going to recover. It could be a capital moratorium, it could be a total moratorium where the interest is also captured into it. So there are certain moratoriums where the interest has to be paid. Then there are certain moratoriums where the interest is calculated and added as a new loan. So different, methodologies based on what the regulator has specified. So you need to understand this. That's called you need to identify the strategic objectives of the business. What is the strategic objective? As I said, long, medium, and short. So the short-term strategic objective would vary, very drastically can vary, especially in this vulnerable environment where things are changing extremely fast than what you think and then even can imagine. Right? So the important thing, the take-home stuff here is identify the strategic objectives of the business is extremely important when designing a high level of compliant risk mitigating framework. Right? So if you take that very same example, the moratorium, yes. So you need to know, okay, whether we are in line with the regulatory requirement. First thing you have to see in this type of situation. So your compliance risk mitigating framework should address this now. I'm taking live examples. Whether the moratoriums that are being practiced and offered by the credit or recoveries or whatever it is, maybe depending on different banks, is it in line with the specified regulation? Regulations are issued. Right? So moratoriums are coming one on top of the other. Every wave, there's a new moratorium coming up and extending the previously granted moratorium and bringing further, expanding the scope, bringing more people into it. Right? Then how that would impact on your impairment, how that would impact on your profitability. Then, and also how it would impact on your the lending capacity, because your debt is not going to be repaid. The banks with very limited capacity to lend, having capital adequacy issues can be one of the most hit serious problems because of the moratorium, because your loan is not getting paid and it's getting deferred. So your the amount that you are going to lend is very much curtailed unless you have sufficient funds to lend. So these are the repercussions. So the compliance need to have a very clear understanding about the strategic objectives of the business. Right? Now, see the amount that we discussed, but the sentence is just a 5-word sentence. But as a practitioner, knowing this sentence is not going to do you much good. As a practitioner, you must understand what you should know about this and whether you are doing that in practice in the bank. That has to be the case. Right? Are you clear on this point? Can I have some answers? Can I have some answers, please?
Yes, sir, it's clear.
Right. So identify the activities of business such as products and services. So you have to have a very clear understanding of as to what your products and services are. Right? Previously also we discussed this comment. What are your products? What is that you are offering? Right? So there are certain banks offer, say, personal loan. That certain finance companies offer non-collateralized facilities. Somewhat similar to granting a TOD in a bank. Just given, without taking any tangible security, basically grant term loans spanning over 3 years. These are certain products. Depending on the the nature of the product or nature of the industry requirement. So there are certain finance companies who are still, even today, grant clean loans. The bankers don't even think of doing it. Granting clean loans without taking any security, right, for customers. Business loans. So the risk levels, is totally high. Totally high. Banks don't even think of doing it. But I'm saying the exact, the ground level situation. Right? So if that is a product that is where the risk appetite test endorsed or are the okayed, and the board is also willing to take risk appetite, that's why it will vary from bank to bank, organization to organization. But based on the risk you are taking, you need to have a quality compliant risk mitigating framework. That's the point I'm stressing here. That's the point I'm stressing here. Right? So you need to know what your products are and what are the associated risks connected with that product or the product line. What are the associated risks that is connected to that particular service offered? Right? So based on it, you need to have your risk mitigating, compliant risk mitigating framework formulated and stipulated to cover those risks. When you're covering the risk, number one is identification of the risk. Then assessing or measuring the risk. Then controlling the risk or rather mitigation of the risk. Right? Then of course, maybe reporting of the risk, maybe externally and internally, so that others will know that there is a risk like that. And bringing more controls to mitigate the risk. So that's the cycle. Right? So compliance is part and parcel of it. They may not be doing the risk mitigation in full, but they have a role to play in it, at least have an understanding, an idea about what are the risks associated with this product at this given moment. And do we have sufficient risk controlling mechanism? Then identify rules and regulations to be complied by business. Again, going back to one of the points that we discussed. So you need to know what are the rules and regulations that covers this area that needs to be complied by the business. Right? Then they determine the risk appetite of business. Right? So board needs to take a call on to determine the risk appetite. Right? So the compliance will make sure that the risk appetite statement is there for the organization. They may not be the one who is preparing it. But to see whether there's a risk appetite statement, whether it has gone before the board, whether it addresses all the risk in full, whether that has been duly reviewed, all this falls within the compliance monitoring. You monitor and see. You may not be the person who drafts that risk appetite document. You may not be the owner of that risk appetite document, but you have a duty to see whether there's a risk appetite document, whether it has been duly crafted, whether it's comprehensive and robust enough, whether it has been timely reviewed, whether you have got the board approval for that, and whether it is being duly followed. Are there any deviations? Whether somebody is checking on those, whether the deviations are there. Now, going and checking whether there are deviations with the risk appetite statement is not the compliance function. It is the CRO's function. CRO needs to make sure whether there are any deviations with the stipulations of the risk appetite document. That's his call. But compliance has a duty to see whether the CRO is doing that. Audit has a duty to see whether the CRO is doing that. Right? So that's why these are interconnected. The implication of risk function on compliance, the implication of compliance function on risk, the implication of audit function on risk, these are connected things. That's why in the relationship we discussed, okay, we have to have good relationship with these different arms Then identify compliance risks faced by the business and how they could be ranked in order of severity. This was the way this one. Then you identify the compliance risk and probably put it into a risk matrix and determine which risk is more severe and rank them in order of the severity and rank them in order of the final impact to the organization. Right? Ranking them in order of severity is one aspect. Ranking them in order of the impact of probable or possible impact of the organization is another one. Then you bring another dimension into play, not only the severity, the probability of that happening. It's a combination of both that would determine the final impact onto the organization on that particular risk. There can be an extremely severe risk, but the probability of that occurring, if it's very, very less, the final impact on the organization, where probably you have to, under the ICAP, you have to keep provision for this. Technically speaking, compliance risk, you have to keep capital separated to meet those risks, depending on this risk, and probably value them in terms of, translate in terms of value, and probably keep a certain amount of capital aside for that, or the ICAP, internal capital adequacy. But all these are part and parcel of compliance. Then identify the risk mitigating methodologies, keeping in line with the agreed risk appetite. Right? Determine the system that should be implemented to review the effectiveness of compliance policies pertaining to risk management system. Identify the risk mitigating methodologies, keeping in line with the risk appetite. So the risk appetite says, okay, we are prepared to take this risk. Right? So are there risk mitigating methodologies captured and then put in place to hold the risk at that level or not? So that's something that you have to think when designing the compliance system and obtaining board approval for that. Right? Certain cases, you may go direct to the board and get approval. In certain cases, you will make sure that somebody else goes to the board and get the board approval. To see whether the board approval is taken either by you or by the other designated party or the entrusted party is your call there. Because the board relies on you, say on compliance, to make sure that the entire risk mitigating compliance risk framework is in place, and normally you are the owner of it. So these are very delicate, processes where the ownership would transfer from department to department, from place to place. The same thing, the way it's implemented, the way it is putting into practice, the way how the bank is taking and structured it within the organization. So to identify the risk mitigating methodologies keeping in line with the agreed risk appetite. Then determine a system that should be implemented to review the effectiveness of the compliance policies pertains to risk management system. Right? So you determine the system that should be implemented to review the effectiveness of the compliance policy. That is where the compliance, I think, it should go into the compliance program. So you have to carry out periodically a compliance check to see whether the procedures within the organization or stipulated procedures are good enough to meet the policy requirement. That has to be done. Right? There are various ways and means of doing it. There's a risk technique called the risk control self-assessment technique. There you pass it on to the process owner himself to make a self-assessment to see whether the risk controls are in place within their organization or within their particular business line or the department. For instance, when you carry out the RCSA, risk control self-assessment, it's a self-assessment. Each business unit will be asked to carry out that RCSA for their own department or the division to see whether the controls, existing controls are good enough to meet the policy requirements and the regulatory requirements and also to run the business in accordance with the risk appetite. Then they need to report back. This is a risk function I'm talking about. That's a technique. So the risk will validate it to see whether the self-assessment done by that process owner or the business owner has been adequately done, and he will give his validation or he will give his recommendations to them. Yes, look at it this way. This is fine, but you need to improve here. You need to upskill or enhance the risk profile or the risk category. It's not medium, it's high. Or what they have said high, you may downgrade it to say, no, you have this control, therefore it should be medium. So, these are all interconnected processes within the organization which will fall in the compliance system of the bank. Compliance system is a very broad one, entailing various stakeholders. Right? You got up to that point? Right. There's a compliance risk faced by the business would continually evolving due to alterations in business strategy, regulations, and laws. Thus, constant review is necessary. This is what I mentioned. The compliance risk faced by the business would continually involving due alteration. It would require alterations from time to time. Why? The business strategy can vary. I told you it's not a thing that's carved in a stone. Especially the short-term strategy can change, requirements can change, specifications can change, the regulatory obligations would be different. So therefore, it would periodically change. And there will be evolvements or involving various alterations in the strategy. Right? So therefore, it needs to be very constantly reviewed. Right? As such, board must be periodically posted at the outcome of the reviews, enabling them to obtain necessary comfort that the risk control framework is effectively in operation. So what does that tell? So board needs to be very clearly updated from time to time. One important thing is having a good compliance system or having a good compliance function, having a good risk function, having a very good and effective audit function, and having the primary level controls and mechanism, the policies, reporting, the procedures, everything. Ultimatum is to avoid surprises. The worst thing a bank can face is a surprising outcome of something. That shouldn't be the case. There should be surprises anywhere. We should proactively see what's going to happen next. What's going to happen if this changes, if this variant, comes into play, or if this particular vertical varies by this degree, what's going to be the impact? That's called the stress testing. There are lots of things that will go into this, when you talk about the compliance system. Right? So you would stress test and see certain things. If your deposit base varies or comes down by 5%, What's going to be the impact? You stress that and see, stress it by 5% and see what are the outcomes. If your capital gets eroded due to impairment, or if the impairment rises by X percentage, what's going to be the impact next month, month after next, like that? You stress the scenario and see what's the impact. These are various risk control mechanisms, but it's part and parcel where the compliance need to know whether these things are in place. Why? If these things are not in place, obviously there will be surprises. There will be surprises, right? The simple thing, you just keep on, growing your balance sheet, your loan book, your asset base, keep on growing without looking into the other consequences. You grant loan, fine, grant loan, you get income, everything is fine. But if you go at that rate, you need to know whether you are going to face any capital constraints, time to come. Whether you will have your funds, adequate funds to lend like that. So these are the things that should be proactively thought and aligning with the business strategy, and then proactively know what could happen if this grows like this, or what could happen if this drops like this. Then you know, okay, if that happens, this is going to be the thing. So that's no surprise. There's no surprise. So you grant loan like that, everybody is happy, and loan book is growing, right? And all are very, very happy. You're raising the flags, and okay, fine. But if you don't see that, at this rate, if you grow, and if you don't grow your deposits or the fund intake, you will have a problem in your capital adequacy. That's going to be very killing, right? So surprises need to be avoided. Therefore, board, not only the board, even the top management at the Executive Risk Committee, ERMC, needs to be periodically posted and updated about the outcomes of your reviews. If you are doing a review by carrying out a stress testing, if you are doing review by carrying out a RCSA exercise, if you are doing a review by carrying out a BCP drill, if you are doing a fire drill to carry out the probable consequences to assess, then there aren't any surprises. For example, okay, you have a high-rise building, right? Or maybe you have a 3-storied building. If you don't carry out a fire drill, I'm just taking a simple example. Carry out a fire drill. If there's a fire that breaks in the maybe the 3rd floor, the 4th floor, how can you rescue the people? Are there any, alternate stairway that they can use? Is it only one stairway available? Or everything is there? Can the fire brigade, the vehicle reach the building? Is there room for that vehicle to be stopped? These are simple things. The front yard, that, of course, the front yard, if it is used as the car park, I'm just taking you the practical scenario. Front yard you take as your car park for customers. And if you have simple things like if the security does not monitor and the customer just park it and go on shopping, right? 2-3 vehicles park like that, and then in a total calamity or difficult situation, you want to move that vehicle out in order to facilitate the parking of that fire brigade near that to do the rescue operation. Is everything gone? No. You can't bring the fire brigade close to it. You can't carry out the rescue operation. You can't rescue the people who are stranded in the 3rd floor. So these are, the unexpected things that can happen, but there shouldn't be a situation like that. That's what I'm trying to say. Banks can't take that those risks. You have to do everything. That's the importance of carrying out the fire drill. then only you know that this problem can come up. Then what you do? Simple thing. You would always instruct and keep on monitoring whether the security guard is on alert for the vehicles that are parked in the front yard of the bank. Right? If that guy is just, neglecting his duty and allowing the customer to park the vehicle and go out, problem in a situation like that. That's going to be, funeral. Very little or nothing you can do at that moment. You might pay dividends or rather penalty by, sacrificing or giving lives of so many people, your staff members. What a critical situation is going to be. Just think. The surprises needs to be avoided. So you need to have your systems and controls in place and keep on monitoring. Now, doing the fire drill is not the compliance function, but the compliance has a duty to make sure that whether the fire drill is being done. Doing the fire drill alone is not enough. What are the outcomes of that? Have we discussed? Has that come up at the internal risk committee? So these are interconnected. Got it? Are you all with me? Audience?
Yes, sir.
Yes or no?
Yes, sir.
Yes,
Right.
sir.
So what did you understand? What is the importance of the things that we discussed? Right? It looks very simple on the face of it, but if these things are not done, right, the result or the outcome can be a catastrophic outcome. Right? It can be a very serious impact that may be created. So that's why these are, being taught and these are being discussed, and that's why these things need to be put into practice in a meaningful manner. Now, do you understand the importance of the risk compliance function within the organization? Yes or no?
Yes, sir.
That's exactly why I'm saying, for me, my personal view, don't take it for your answers or anything. In textbooks, it says compliance and the risk are the second line of defense. But as far as a practitioner, by seeing both sides of the coin and having experience in compliance, risk and audit and business and everything, I would rate compliance at the the third line of defense, would even sit above. That's my personal. Only thing, to establish that and put it, you need to submit a research paper and all that, which I'm not interested in doing at this age, right? But I'm just opening it out for you all. If you can think about it, you can't just say and then establish it, but you can make it as your personal view, which I'm doing. That's why I'm saying don't answer if you're answering any other examination. In the textbook, it's defined differently. But for me, I personally feel compliance is the third line of defense. I personally feel. So if you are quoting, you need to quote with that. And so said he personally feels. If somebody asks me, then I can explain. But it's put in a different way. Why I'm saying that is to show the importance of compliance, because I really feel it's so important, and that scope is so wide. The scope is so wide when you put these things together and blend with the practical scenarios, right? This is what I see in it. Right? So that's why the compliance function is so important and so difficult. If you have to really, really play it at the best way. Right? And that's why you have to be a consultant physician to do, because you need to understand the business and the other process verticals also properly. Right. So having said that, we will just take a break. So we finished developing compliance policies. Okay. That slide and right. Okay. This slide we finished now. Yeah. Okay. Right. Now, meeting the regulatory objectives, right? Now, all this time we were talking about the developing the compliance system, right? Now, framing compliance policies and procedures. So, meeting regulatory objectives, the compliance policies and procedures need to be designed by taking into account the following common regulatory objectives. Maintain confidence in the financial sector by ensuring market stability and soundness of FIs, protecting investors and depositors, preserving market integrity, example by reducing financial crime and market abuse, achieving a risk-based approach to compliance. Okay. So when you are meeting the regulatory objectives in designing or framing the compliance policies and procedures, so these are the things that you have to look at, or these are these are going to be the objectives of you in doing that. One is to maintain confidence in the financial sector. So you have to always ensure that the confidence of the financial sector is maintained in order to ensure the market stability and the soundness of the FI. Now, when you take the economy, the financial institutions, the banks especially, the financial institutions play a very big vital role in the economy, right? So the soundness of the financial institution, which is part and parcel of the central bank objectives, or also soundness of and the stability of the financial system, right, is important, and that is why they are doing introducing regulations and regulating the industry. So when it comes to the organization or the FI or the bank, you have to have your compliance policies and procedures designed in such a way that keeping these objectives in mind. One is to maintain the confidence of the financial sector or the system in your organization, because when you say you put out your annual report or maybe your websites and all, you will, especially when it goes to the annual report, which generally any listed or a public quoted company, they need to publish their accounts, and the annual report needs to be public. So it's going to be in the public domain. So anybody can go into the system and find out how this business is run, how robust policies and procedures are there. And if you go through the annual report, you will see there's a risk report, very comprehensive risk report, right? Then there are various compliance requirements. Basically, the governance requirements are captured into your annual report, and the annual report will say under each item whether it's compliant or not, or in the process of being compliant. All that information needs to be given. That's with the information is the public domain. So by doing all this, you are making the public aware of what's taking place within your organization, where the business is done in a transparent manner, and the reportings are done properly, right? So when you're framing your policies, you have to always keep in mind that you frame the policy keeping this objective in mind, to maintain or rather to have the confidence of the sector, your customers, as a whole, the financial sector have confidence in you, which in turn will help to or rather facilitate soundness of the bank and the FI. Protecting investors and depositors. So you need to have your compliance policies, having that in mind, to make sure that you protect your customers, that is, those are the depositors mainly, and also the investors, right? You need to safeguard your customers from the moral hazard issues, where the customers' deposits can be, threatened. So you have to give them the confidence that no, your monies are in our safe hands. That's where the public confidence builds up. And if the public confidence is lost on you, it can lead up to a run on the bank. The bank can collapse, right? So it's your deposits that you are lending more than the stakeholders' money or shareholders' money, right? If I ask you the question, what is your largest asset within the organization? In your balance sheet, you have assets and liabilities. If I ask you the question, what is your largest asset? Can somebody answer?
Lending portfolio.
Sorry?
The lending portfolio. Lending portfolio.
Yeah. So yeah, right. Your largest asset is your loan book, right? The loans and advances. So my next question is, what finances your asset? All your assets need to be financed by something, no? What is the source of financing the asset book? Mainly.
The deposits. Deposits.
Deposits. You're right. So if you take any bank or the financial sector, your loan book is financed more than 75%. In some cases, it's going up to 95% by the deposits, right? So you lend basically the customer deposits, right? And at the same time, we need to give the confidence to the customer that their monies or capital that they have invested in us will be paid on demand, right? So that assurance is given. So how much of the customer funds needs to be kept with you in order to meet this demand? I'm just talking about practical scenario. In practice, how much of customer funds are kept with the bank in order to pay them back? Can somebody answer? Let it not be a direct. Sorry. Yeah, sorry about it. Let it not be a direct figure. You can explain. How much of deposits you need to keep aside? What is the rationale or the mechanism you have? Because now you all said, okay, the largest asset is the loan book, and the loan book is to a very great extent financed by the deposit. Right? When you say the loan book is financed by the deposit, what does it mean? You are using the deposits to lend, right? Agree? At the same time, you all say, okay, we know the deposits are supposed to be paid on demand, especially the savings and current account, and even FDs, though it's tagged for a given designated time period, tenor, right? If the customer wants, we pay, right? So I'll ask you the question: if all your customers come and ask for the money that they have deposited, can a bank pay it? Can any bank pay it?
Not at once.
You can't pay, right? Because you have invested that money in various, investments like lending, maybe other investments and things like that. You generally keep roughly around 10% of your cash for your day-to-day payments. Then SRR is also kept in cash order T-bill form with central bank. Okay. Then you have to set aside for various other capital requirements. The funds need to be allocated for various other requirements. And then there will be a residual balance that is left, right? Say 60 or 70 or 75 or 80% of your total deposit, you identify, which you call the loanable funds. After setting off for various requirements like the SRR, and then maybe for your, to honor the payments of the customers, and maybe for various other, the due payments and things like that. The balance left, you can name it as the loanable funds. So out of the total loanable funds, how much will you lend? How much can you lend? Answer? Can make you in a while, it's okay. We are in the learning room.
Leaving out the SRR requirement.
No, all that after leaving everything out, only we arrive at the loanable funds. Right? So we have the loanable funds. This amount can be lent. I'm asking you, a prudent banker would lend, say you have the loanable funds, say X amount. Right? Will you lend the entire X amount or not? In practice? You would lend or not? You can answer somebody. Those who have done credit into finance.
We maintain a leeway and lend.
What is the leeway?
At least, say, if it's a cashback facility, about 10%.
So you set aside all that. That's how you arrive at the loanable funds. That's why I named it loanable funds. You have cost of funds, you have cost of loanable funds. Which is higher? You have a thing called the cost of funds. And you have another, criteria called the cost of loanable funds, which is supposed to be higher, or which is higher basically. Think simple thing. How do you arrive at the loanable fund? After setting off certain things that you need to set off for various specific reasons, like SRR, to pay the the demand of the customers on their deposits and things like that, and maybe to allocate certain funds for based on your cash flow, that certain payment dues are falling in a week's time or a month's time or whatever it is. So you have to allocate funds. Right? So the cost of loanable funds are higher or lower? Which is higher? Cost of funds, cost of loanable funds. Cost of loanable funds are higher than the cost of funds. Right? Because there's a certain component you have set aside. Now, when you say cost of funds in simple terms, how much you pay, how much cost that you incur in raising that fund. If you do there are other complications coming in, but if you make the equation very simple, it is the interest cost. right? There's so many other things get added because there's SRR and other things, factoring and all that. So, but interest cost, say the interest cost that you incur in mobilizing that deposit is the cost of funds in the simple terms, right? It is exactly not that. Right? So, say you say 100 rupees, you borrow from a customer by way of a deposit, say at 6%. That's your cost of funds in simple terms. Huh? If you forget about the other things surrounding, cost of funds is 6%. But out of that 100 rupees costs you 6 rupees. Now, out of that 100 rupees, you set aside, say, 6 rupees for SRR alone. Then you have how much? 94, right? You don't have the 100. For that 94, you are paying the same rate, 6%, right? If you work out on that, obviously the cost of that 96 rupees, because you are paying 6 rupees as interest for the entire 96. Because you don't have 100 for lend now, because you have set aside for 6 rupees for the SRR. You are making the equation very simple. You will have only 94 rupees because you have set aside. So that is why the cost of loanable funds are always higher than the cost of funds. Right? Any accountants here? Right. So my point is, so in such a scenario, now if you lose the confidence of the customer, right? Because you, and my question was, you have 94 rupees in this simple example. And how much out of that 94 you will lend? Which we, once you identify it as loanable funds, how much will you lend? You will lend, if possible, the entire 94. Otherwise, it will be idling of funds. That is how the banking system works. Right? You try to minimize the idling funds. Either you lend or you invest or you do something. You don't keep cash in your wallet. Because that's going to be called as idling funds. Funds that are idling without making generating any return, but where there's a cost only. Right? So when in the cost optimization, you try to make a return out of every thing that you spend. You have spent interest to mobilize that deposit. So you have to, technically speaking, lend the entire 94 rupees to make optimize the return. So in that type of scenario, that's what I say, no bank in the world, not only in Sri Lanka, can pay every customer if everybody, clocks and then asks for their money at the same time. No bank in the world can pay. That is how the banking system works. Therefore, it is important to maintain the customer, the confidence. Because if the confidence, the customer is lost, everything will be lost overnight. That you can't prevent. You saw that a couple of years ago, maybe, or a decade ago, we saw in Sri Lanka itself, certain bank, especially due to loss of confidence. There again, that contagion effect concept comes into play. It was nothing to do with that particular bank, but it was something to do with that group. Then the customers got panic and then they lost confidence and they were trying to draw their money out. And the bank was almost at the verge of being collapsed. So you can't pay. You will see big queues forming up in front of your bank branches. Customers wanting their money back. So you can't pay it. There's an example where when the customer confidence is lost, what will happen to it? It will end up with a bank run on the bank. Right? So that time what happened? The central bank intervened and then they took some remedial action. So as a result, the position was restored. At that time, I remember There were inquiries from us as bankers. Customers are asking, okay, this bank is now collapsing. Is it true that this bank is also going to collapse? So there was truth in some of those, because that contagion effect was very high. The bank that they were referring to, I don't want to name those banks for very obvious reasons. It's not ethical, right? So the word goes out very fast. They're asking, make a veteran, that's the rumor. Then it's like wildfire. Everybody, so contagion effect is high. I mean, people don't know about the contagion effect than average ordinary person. But the message goes wrong. It triggers from the fact that there's high contagion effect among the banks. The point what I'm trying to drive here is banks are highly vulnerable in terms of the contagion effect. Something happens in one bank can go and trigger issues and effects on the other banks, and likewise in the entire sector for that matter. Right? The system can collapse, the banking system can collapse. So therefore, it's important to maintain the public confidence and especially the customer confidence at very high level, right? So in order to do that, you have to make sure that the customer confidence is very well maintained, right? Then protecting the investors and depositors, again connected to same. Then the preserving market integrity, for example, reducing the financial crime and market abuse. Now the market integrity is something where, again, the customers would look at, right? Now, say a bank is in trouble. So it goes by the word of mouth. It spreads, the rumor spreads. This bank is struggling, right? So then the market integrity or the customer confidence on that bank is at stake. So this can happen due to many reasons. One is if there's financial crime within the organization, or if an organization identified as aiding and abetting financial crime, or in other words, if a bank has been slapped with a fine by the regulator saying that business was conducted in a non-compliant manner. Now, in the foreign countries, these things are published. When a penalty is slapped or fine is imposed, it's published, right? That's what it says. One of those, the largest penalties was slapped on the HSBC. Another largest, if I remember right, it was something like, subject to correction, 9.8 billion US dollar fine. Then BNP Paribas, there was another huge amount of some 13.8 billion US dollar fine. BNP Paribas, some time back, right? So these are, the happening where the customer confidence can be lost, right? So if that happens, and if there's rumor or some information to say that the market abuse, where the employees or the bank was, involved in abusing the market, breaching the integrity levels of the bank by its employees, the top level, right? Then you are not preserving your market integrity, right? So compliance policies, when you are framing, you have to always keep that as an objective. How do you prevent such a situation by putting the bank into a condition where your market integrity is at threat? So you need to frame your policies to avoid that type of situation, right? Then again, framing it, you have to achieve the risk-based approach to compliance. We touched on it the last lecture, I suppose, last week. When you do your compliance program, probably you have to use the risk-based approach in formulating your compliance program for the year, which should comprise of planned activities and the unplanned activities, right? Planned activities and ad hoc activities that comes up, right? So you have to use the risk-based approach. So when you are framing your compliance, meeting the regulatory requirements by creating the policies and obtaining board commitment, you have to keep that in mind, that you have to more or less use the risk-based approach to compliance in defining those frameworks. Why? Your resources are limited. The areas to be covered are fairly large, right? So you have to do it in a systematic way where you would use the risk-based approach in identifying the high-risk areas that needs to come on your radar, right? And continuing on the subject, right? Framing compliance policies and procedures, right? Which include rules as well. There are certain rules which we call prudential rules. What are prudential rules? Right? So these are the rules that revolves around the soundness of the bank and taking it as a going concern. There are two different things. And if you're an accountant, you will see our accounts are based on one main concept called going concern. Going concern. That is why you have the receivables, payables, in short. Going concern is not to end today. Right? Balance sheet is a snapshot. P&L is a snapshot. But in bringing figures into the balance sheet, the P&L and the other financial statements, the underlying concept is that the institution is a going concern, is moving. It's not going to stop its operations tomorrow. So the accounting principles are based on this concept called the going concern. That's why you have payables, receivables, advances, then the prepayments, then the debtors, credit, all these things will come into play with this. So in this scenario where you are defining the prudential rules, right? It always revolves around or entails bringing those rules with an idea of ensuring the soundness of the bank and also its going concern. Bank can be sound today, but if there's no going concern, we have no assurance to say that it will be sound tomorrow as well. And it will be sound day after as well. Because things are moving, things are changing. Environment is changing, business strategies are changing, the threats and the strengths would also change. Your targets are changing, your directions are going to change. The entire scope is going to take, it's going to be a total different landscape of economic landscape that you are going to face tomorrow or day after. But still, the customers and the depositors and the investors, basically, the stakeholders needs to be given the assurance that the bank is sound and it's on a going concern. Then only they will come and invest with it. Right. So in these prudential rules, the key areas that would have are capital adequacy. So you have to have your capital adequacy. That's why the regulator has stipulated, right? What is the capital adequacy that you have to maintain? Right? So just as a small exercise for the tomorrow's class or the next week class, I want the participants to go through your directions and the regulation and come and present, right? I may ask somebody to make a small presentation of 5 minutes to tell the class what are the capital adequacy requirements specified by the central bank. And of course, it's on a increasing the trend. By 2022, where should we be? And it have been broken into size of the bank also. Banks with a minimum capital of this amount, bank with a capital in excess of this amount, put into two different categories, right? So those are prudential regulations. So can you all make a note of it when you come for the next class? Please do come prepared to make a small presentation of 5 minutes to tell what this capital adequacy requirements are as specified by the regulator, right? So example for a prudential regulation is the capital adequacy requirement, then the solvency liquidity requirement, liquidity ratio, how much of liquidity you need to have, right? Then the management of the bank assets and liabilities. We have a committee in the bank called ALCO, which is a very important functional committee within the bank, in order to look at and assess the assets and liabilities, because there can't be a mismatch in this, right? Your assets are financed by basically your liabilities, including your capital and maybe the other deposits and things like that, and other, payables. So assets and liabilities need to be very carefully managed within the bank. So that's why this ALCO is there. And ALCO is supposed to be chaired by the CEO of the company. This is what the regulator has always recommended, because it's so important. Then prevention of financial crime and combating financing of terrorism. How do you prevent this happening? Prudential rule. How do you prevent that happen? What kind of action you take to prevent it happening? Taking KYC is one of those key steps in preventing financial crime happening. Why? What is money laundering as per the PMLA? It is a process by which, right, the money launderers try to hide the true origin of illegally made money, right? And section 3 of the PMLA says, anybody who receives, possesses, I'm just saying off the cuff, you would have learned, right? Any property made out of unlawful activity, right? Anybody who deals with any property made out of unlawful activity is further defined and connected to the predicate offenses given in the PMLA, and there are so many predicate offenses that have been set out in the PMLA. So anybody making any money by engaging in any unlawful activity is considered money laundering as per the section 3 of the PMLA. And how the banks get involved is section 3 is subsection B tells, if anybody receives, possesses, right, invests, brings into Sri Lanka, takes out of Sri Lanka, any proceeds of crime, or rather any property made out of unlawful activity, would also be committing that offense called money laundering. That is where the banks get involved, right? Because you take a bank, you receive, you just imagine the property is money is property, you receive money, you possess them once you receive, you invest such money, right? You take into Sri Lanka, inward remittances, you send out of Sri Lanka based on the customer request, outward remittances, right? You do all these activities with that property called money. But in case, as per the Section 3 of the Prevention of Money Laundering Act number 5 of 2006, if such property, say that money, is made out of unlawful activity, which is connected to any one of those predicate offences given as per the Act, the banker will also be responsible for money laundering, which is a crime in Sri Lanka by way of this Act, by not having it in the penal code. Generally, the crimes are listed in the penal code of the country. But here, there's a penal code doesn't carry a crime called money laundering. It has been made a crime through the PMLA. Now, the point what I'm saying is, so the banker happens to take any money from a customer, knowingly or unknowingly, or having reasons to know that such money has been derived out of unlawful activity, he will be liable for money laundering. The banker will be liable for money laundering, right? So then how to avoid this? But the bank, when you are bringing money, customers will bring money, the numbers are huge. Numbers are very big, in millions, right? You have millions of customers in the bank. And you will probably have your branches operating all over the country, right? So it can happen in even one of those remote in the cornered branch. But still the bank will be liable for money laundering. Board of directors will be liable for money laundering. Compliance officer will be liable for money laundering. So the prudential rules, you are talking about the prudential rules, how to prevent that happening, how to prevent financial crime, right? So, and the law has a rebuttable presumption, if you have understood it. It says, if the transaction that run through an account, in terms of its volume and also in terms of the pattern, does not go well in line with the customer's known profile, the law presumes it as money is made out of illegal activity. I'm trespassing into a different area, but what I'm trying to say is the point here, right? Then to see whether, as per the rebuttable presumption, you will always need to have KYC to make a profile of the customer. Because you are going to compare that money in terms of value and trend with the profile of the customer. The profile of the customer can be made by taking KYC. That's how you create the profile of the customer, right? I won't go in detail. I hope you understood what I'm trying to say. So, as a prudential rule, you have to take KYC. After taking KYC, you need to make the customer profiles and put them on different risk pedestals: high risk, medium risk, and low risk. So these are prudential rules. That's why KYC has been made compulsory. That's why the risk profiling of the customers in terms of in AML CFT terms has been made mandatory. That's why probably you are getting the support of the system to do the ongoing due diligence. Those are prudential rules. My point here is not to teach you money laundering. Probably you have learned it in this course through another resource person. I took that example to make clear to you the term of prudential rules and prevention of financial crime and combating is done through prudential rules. Preventing. How do you prevent? You take KYC, then you do your risk profiling, then you do your ongoing due diligence. Probably you have various scenarios built into your anti-money laundering monitoring system, where it will go and trace and track and then give you alerts. And then the suspicious transactions will be scrutinized at different levels. And if it is again established that, okay, it's a violation or it doesn't match with the customer known profile, those who are in AML would understand what I'm saying, then you will report it. for you to report, you need to have that environment. For you to have that environment, that is why it has been made a prudential rule to have all these things in place. So you are going to prevent that happening. That's an example for a prudential. Then regular reporting and the financial return, prudential rule. You have to do your reporting properly as per the Sri Lanka accounting standards, which is again stemming from the IFR, International Financial Reporting Standards. Based on it, the Sri Lanka reporting standards and the accounting standards have been formulated. These are all, the global phenomena. Why this reporting is to be made? All listed companies need to publish their accounts, financial accounts every quarter. Prudential regulation, prudential rule, so that, the public will be aware. There are no surprises. And by doing it, they themselves will know where they stand. Right? So those are the examples for prudential rules and the financial returns. You have to send, a large number of financial returns and various other returns to central bank regulator on due dates. Some are daily, some are weekly, some are fortnightly, some are monthly, some are quarterly, some are half yearly, some are annually. Various returns do go. These are prudential rules in order to make sure, and on a daily basis, trigger points are in, early warning signals, prudential regulation, prudential requirement, in order to prevent certain things happening. Right? So the implements control to manage, mitigate, and transfer risk. Prudential rules are meant for that, to manage, mitigate, and transfer risk. Right? You manage the risk, you mitigate the risk, and sometimes you transfer the risk. By taking insurance and various other precautions like that, then you transfer the risk. Right? So in managing risk, the compliance controls may be either top-down or bottom-up. Now, you looked at the prudential rules and regulations, and then now in doing that, in managing such risk, various compliance controls needs to be put into practice, which is classified into two segments. We call them top-down approach and the bottom-up approach. Or in nature, top-down and bottom-up. Right? All these are prudential. Prudential means we are trying to prevent that before happening. Prudential rule. So the top-down approach, prevention control, it may be defined as control within the compliance and the risk framework that are managed and agreed by board and delegated downwards. So, example, for the top-down approach, those are basically controls. Controls you find within the compliance and the risk framework of the bank, which has been endorsed by the board and delegated downwards for due implementation. That's why we call it the top-down approach. Right? Essentially, the prudential controls to manage the compliance risks are proactively. So those are proactive to prevent. Right? So all prudential rules are proactive rules. They're trying to prevent. Examples, including obtaining KYC before opening accounts. I think I explained that to a very great extent. Then carrying out CDD, doing continuous due diligence, prudential regulation. That's why the central bank, the FIU minimum rules and regulations stemming from the PMLA Act, Prevention of Money Laundering Act, it has made it mandatory for the bank to carry out the continuous due diligence on the customer, continuously. Then another example is the complaint handling procedure, which is part and parcel of the customer charter. Right? You have to have a complaint handling procedure. Everything needs to be, recorded. Whether a complaint is resolved on the spot, still it needs to be recorded and it needs to be upgraded or rather escalated to the reporting officer, complaint resolution officer, who is in charge of all the handling and resolving all complaints coming to the bank, internally as well as externally, right? So this procedure needs to be, is a well-documented procedure. So all complaints needs to be solved immediately. If not, customer needs to be acknowledged. You know, these are, I'm not going to talk about it now, right? So if you learn it through the customer charter and various other the industry best practices, how the complaint resolution is done, this is to prevent this happening. Then the product clearance, the product development, the compliance clearance on the product before it's implemented. Sometimes clearance on the product before any terms of the product is altered, modified. Compliance clearance is necessary. That's why I say you need to be part of the product development cycle right at the beginning, so that you don't have to go and change the model or the product fully when it is about to be launched. Right? So these are examples for prudential controls or the prudential rules and the top-down approach. Then what is bottom-up approach? Those are called detection control. Right? Detection control. So you can define them as the second level of controls, embedded within operational processes, and are used to identify breaches of top-down prevention control. Right? So these are supposed to be more costly. The bottom-up control. Right? The bottom-up controls are generally treated as second-level control and is embedded within the operational process, and aiming at identification of the breaches of the top-down control. That's bottom-up. Examples, maybe you're checking your audit trail, right? Then the EOD checks, and probably in the new environment, checking it through the PAM solution, Privileged Access Management System, by carrying out customer reviews, right? Basically carrying out audit examination to see whether the stipulated procedures are duly being done. So these are bottom-up controls. Bottom-up controls are generally, it's more expensive towards implementation than the top-down control, because it involves more time, more money, more people, resources, right? And they are generally focused on high risk, comparatively high risk area, higher risk area. Bottom-up control, right? Right. Then the key areas to be covered in the compliance policies and procedures: AML CFT requirements. So when you are framing the compliance policies procedures, AML CFT requirements is a mandatory area that needs your focus. Most banks have a different policy, a separate policy for AML CFT, right? I think all banks have. You have to have a separate policy and procedure as to how you are managing your AML CFT. Then the outsourcing of business operation. There's a direction on this as well, right? You all should be familiar how important this outsourcing business operations direction is of fulfilling the, meeting the requirement of this direction. How important it is. Just go through it and find out, right? Can I leave that as some homework for all the participants for next week? Just to take 5 minutes. So this will, make you to go through AML CFT, then the outsourcing of business software, how important it is. When you go through it and coupled with what you are going to learn today, you will understand, right? As time permits, we'll just take one or two and let's see whether, you can go through the document and come back. I mean, the outsourcing business operations, it says, okay, there are certain areas that cannot be outsourced at any cost. It has to be handled by the bank. Example, the audit function, the risk function. Audit function of certain areas have been exempted subsequently, as long as it is done under the direct supervision of the chief internal auditor of the bank. This function cannot be outsourced, the compliance function cannot be outsourced, the finance function cannot be outsourced. So there are certain areas that have been earmarked, very clearly spelled out in the direction. Those areas cannot be, treasury function cannot be outsourced, right? Because it's so important. But when outsourcing, what needs to be looked at, how you need to assess the party to whom you are going to outsource in terms of expertise, in terms of its capability, in terms of its capacity, and to carry out KYC on them, carry out due diligence on them, right? Whether you will have a system to fall back if we are going to withdraw it from them and to do it in-house. There are so many things there. So when you are framing that, the compliance policies, these are very important areas that need to be given due attention because of this reason. Then the whistleblowing procedure. How effective the whistleblowing procedure is, it is stemming from, as I've seen it in some of the governance regulations as well, right? And stemming from the Basel recommendations. Whistleblowing. If some wrongdoing is happening within the organization, the whistleblowing procedure should pave the way for somebody who wants to blow the whistle and alarm the parties concerned that there's something that is happening, right? So in army camp or in a scout contingent, whistleblowing is done in order to convey messages, right? So different ways of whistling. In the scout movement, will give the message saying, okay, this means the leader wants you to assemble in one place. The leader is conveying you, there's something, some danger is taking place. So move out. So different, whistleblowing. So likewise, whistleblowing procedure. Open it out to all the stakeholders of the organization to blow the whistle. Should they see that, there's certain wrongdoing and undesired activities and things taking place within the organization, which can harm the reputation and the stability and soundness of the bank or the organization, right? So the fit and proper requirement. How do you assess the fit and proper of the people? Before assigning important tasks, the corporate management level tasks, right? So those are another area where compliance needs to, be aware and be mindful of whether the bank has this fit and proper requirements, the, policies within the bank, whether there are policies for training and competency, upgrading of competency and the knowledge and the skill. Are there any policies, right? Whether there's a capital adequacy policy covering the capital adequacy requirement. Very important. Having a policy itself tells that there's a function of that area that is coming under the radar of the board of directors. Why it should come under the radar of the board of directors? Because it's so important. Any breach on those areas can be, total funeral for the bank. can be disastrous, right? So therefore they have to go through. So these are, next is the conflict of interest. Right? How do you manage conflict of interest with the organization? Right? So these areas needs to be covered or focused when you are defining the compliance policies and procedures. Is that clear up to that point? Any questions? Right? We'll move on. Then confidentiality requirement. How do you maintain the confidentiality requirement? The banker's duty of secrecy. Right? The data protection. How do you maintain this? Right? So are we sticking to the requirements of the banker's duty of secrecy, which have been spelled in the Banking Act? I think section 77. Not very sure, right? So it says the duty of secrecy is not absolute but qualified, right? So that means the banker needs to always maintain the confidentiality of the information available with them about the customers. You cannot breach it. But at the same time, it's a qualified requirement. It's not an absolute requirement. So you cannot divulge that information because it's going to be a breach of the duty of secrecy to a customer. And it says it's not qualified, it's not absolute, but qualified. Means under certain conditions, you can breach the duty of secrecy. Right? So you have to have an idea of all these requirements when you are framing the compliance policies and procedures. Right? So going back to the duty of secrecy, as per the Banking Act, you can disclose the details of the account under certain circumstances in the interest of the bank, in the interest of the country, if the consent, either written or implied consent, is provided by the customer for disclosure, right? Then interest of the country, interest of the bank, right? The example is, say you go for litigation or something, you can, in the interest of the bank, probably you may come out with their borrowings and things like that. Right? So then the data protection, confidence requirement. You have to protect your data. How important it is to protect the data, because what is the expensive most commodity today in the world? If I ask you the question, the expensive most commodity in the world. What? I would say one of the expensive most commodities in the world.
Information.
Data. Right? Data is very, very expensive. Right? That's why they try to take your database. They try to, rob your database, access your database, because it's very important in terms of business. Right? So the data protection is very important. Right? How do you do data protection? The compliance will have to look at this also. whether the company or the bank has policies to protect its data by falling in line with the ISSP policies issued by central bank, by carrying out various, network security vulnerability assessment, internal, external, right? So, what kind of the technical support we have to protect our data? How have you sort of allowed access to this data? Who are the owners of this data? Right? So there will be so many questions that can arise as far as the data protection is concerned. Right? So in the today's environment, people are working from home. Order of the day. So, new situation. You have to work from home, but you can't go to office. When you are working from home, your data is shared onto your device. So are we ready with our policies and procedures in doing this? So that's extremely important. Then the market abuse, right? Whether you are going to abuse the market, insider dealings, right? Disclosure requirement. The financial disclosure and various other qualitative aspects need to be disclosed. From audit point of view, you have to disclose the CAMs, key audit matters. So, what controls are in place in protecting data? Whether we have, various, data protection controls by, working only on the designated devices, right? So those are another important area that you have to have in mind in framing those policies. And the disclosure, not only financial, as I told you, so it can be various disclosures like, the risk committee, the audit function, and various ratios, right? And the CAM, the key audit matters, right? So we'll have different types of information. So when you do this, do we have your policies for data protection? And whether you have carried out this vulnerability assessment, internal, external? And what are the gaps that you have seen in those? So are those the risk arising due to those gaps? Are they high, medium, or low? So if it is so high, what action have we taken? Then if it is not so high, then what kind of precautions we can take? How can we handle segregation of duties, the password administration, then the monitoring of privilege access users? So these are the areas that you have to look at. Then the CSR, the socially CSR projects, the bringing the concept of people planet and processes, 3 Ps, right? So the disclosure, the CSR initiatives also needs to be disclosed. How green your concepts are, right? Then again, handling customer complaints like what we discussed, having a complaint resolution officer, and then by looking at the areas where there are regular issues coming up, there are so on and so forth. Then very importantly, you have the record keeping. How do you keep your records? How do you keep your the information recorded, including the record keeping on AMS-CFT, where you have static records and the dynamic record, then the retention period of record keeping, how long you have to keep. So under certain exceptional circumstances, the retention period would not apply. Then how many years ahead that you have to keep this information? So likewise, there are so many areas which needs to be looked at when framing your policies and procedures, areas that need to be looked at by you. Right. So we will stop our session today at this point, but don't go out. I have a few things to discuss with you. We will start drafting of the compliance report from at the next class. At the same time, I just want you to inform you that we are, I think I mentioned right at the beginning that we are going to carry out some group exercises, group assignments on the various topics given. And then it will attract 30 marks out of the total questions you are going to answer on the area that I am going to cover. So in the examination paper, you will answer 3 questions out of 5 questions from the area that I am covering. Out of 5, you have to answer 3 questions. So out of that, 30 marks will come from this assignment, from my assignment. So that's the basis. 30 marks from the assignment and 70 marks from the sit-down paper, right? So you all will be put into different groups, and we will, by next week or even before that, we will share with you the topics that you got to work on, and you need to work as a group, right? You can get in touch with them over Zoom or, various other e-platforms. And the exercise, the topic given, you all need to make 3 documents. One is that executive summary, which gives the cream of the content in the paper you are going to prepare, right? Executive summary. Then you will do the document. I will give you the specifications when I am writing to you, or when I will get the IBSL to write to you after grouping you all. So the main report, right, should carry comprehensive information pertains to that topic given, and the executive summary will carry the cream of the information that you have gathered there, 2 documents, and the last document is your presentation. You need to do a PowerPoint presentation, and All 3 documents you can prepare and send it to the IBSL. I will get those from them. And thereafter, we are taking presentations based on the document that you have prepared. And each group will be assessed. A, based on the document that you prepare, the executive summary and the main document, and certain part of marks will be given to the presentation based on the slideshow that you are preparing, which should cover the content, the summary of the content that you are giving in your paper presentation, right? So each group will have about 10 to 15 minutes. Those specifications I'll let you know. Time of presentation. And after the presentation, you will be questioned, queried by me on certain areas based on your presentation, based on the document that you have submitted, right? And I would invite every member of the group to actively contribute. In grouping also, we would always look at to put you into different groups that represent different sectors. Now, say there are multiple participants from a particular bank, ideally would be put into different groups. With the simple, valid reason to say in this group exercise, it's a knowledge sharing. It's a participative activity where you would contribute, do your research, do your reading, and contribute. So different organization cultures, different knowledge, different expertise will come into play. And this is the methodology used for the good quality master's degrees, where you would bring people from different business disciplines, different business environment, from different business cultures, different knowledge, different expertise in different disciplines, put together so that all those will be shared in putting out the final product, which is definitely done with a purpose in mind to enhance the quality of the output, which will be shared among the entire group. So in designing assigning the topics, I would rather take certain areas that has lots of importance to the compliance function, but not generally dealt with on a day-to-day basis, but important, very important to know. And the content of the diploma program cannot cover all these areas because with the limited time allocated for the program. But still, nevertheless, we can use this tool to cover those areas as well by way of research, by way of your studies, and by way of preparing your reports, slideshows, the executive summaries, all that. So the knowledge that one group gathers will be shared with the entire community of the class. So, say for example, if there are 10 groups doing 10 different topics, it's like everybody having access to 10 different work areas, including the area that's handled by them. So that's a tool we are using here in order to share knowledge, share expertise, share competencies, right? Share awareness. So that's how it will work. And because there are mostly requests to put the people in the same bank, in the same group, which we do not do. for very obvious reasons, because we want a good mix to come in. Interaction, networking, all this matters. Especially it will be important in this environment where you don't see each other. You don't see each other, right? So it's an opportunity for you to do your networking, do your contact, have your research, have your knowledge sharing, and finally need to come out with the final product where you will make a presentation, right? So that's the suggestion from me, and I would invite, if you have any suggestions, better suggestions, I am most happy to listen and then to see whether it's worth implementing it. Any views from your side? Participants?
So roughly how many members per team?
It depends, because I am told this group has about 80 odd people registered for the program. But I see basically today, I think I see the largest numbers, about 36, 37, 38, maybe 39, 40 people logged in today, right? But this group supposed to be having 80 odd people. So all of them have to take part in this, right? So ideally, I would like to have 8 groups, but having 10 people in a group will also not serve the purpose. So I might have to have more groups, which means more time for presentation, right? And as long as we can, so those are the obstacles that I have in having such a large number in one batch, putting them into groups. So ideally, in my personal view, having 5 people in a group is the best, 5 to 6. So let's see, let's play by the ear. I have to look at the numbers and decide. Probably we'll liaise with IBSL and get in touch with you all through IBSL. They will probably inform you. And in the database, probably, okay, they have your bank, they have your contact number, they have your email addresses. And also, if you have not submitted, I would invite you to submit your designation and the area that you handle. That will also help me to bring diversity into this grouping, so that people with different expertise, different disciplines will go into different groups, right? If that information not submitted, I'll tell IBSL to gather that information as well. So that will also help me to group you all in a kind of a better way, so that the ultimatum is achieved more kind of efficiently and productively. So if your work area and the designation not shared, you can do that. I will get them to send you a mail, so they will capture them and we'll do the grouping system. Any other questions? The topics will not be the area that we are covering here, right? So those are areas that are not directly covered in this program due to various time constraints and other things, but which are very, very important for the compliance to know and have knowledge about. So those are basically the topics will be like that. Grouping system is that. The model I told you have 3 documents: executive summary, the main document. I'll give you the specification, the length and the number of words and things like that. And third one will be the PowerPoint presentation, which you will use to make the key points presented. And I want every staff member, every member of the group to take involved actively in the entire group exercise. If anybody is not acting, I think better not carry passengers in your group, right? Because anyway, 30 marks will be given, right? So they have to earn those marks, and marks cannot be given on a platter, right? So I will have my own ways and mechanisms to see and make my judgment as to the involvement, because when you are making the presentation, you will probably make the presentation, share it among your other members, the group, to do on a sectionalized basis. But when I am querying, I will have the liberty to query anybody from anywhere in the group. If it's a group exercise, every member needs to know, right? So if, say, the first two slides presented by A, I might ask the question from C about the first two slides to clarify further, or some point like that. So that's liberty I have. Then I would know exactly whether what involvement he or she has. So, and also if they are not actively involved, I think the groups need to tell that these parties are not involved, because this is part of the learning, this is part of the exercise, and since the fact that there are certain marks allocated for this, we need to make sure that everybody is in it and at it, right? So that's the message from me. Any other views, please? Any other views? Yeah. Okay. So in the absence of any other views coming from you, so it's nice to see the numbers are growing, right? Okay. So if there are any other friends of yours who are not coming in, I think this is the time that they need to make a concerted effort in joining these forums and actively take part in this group exercises, which will earn you 30 marks. 30 marks out of the 30% will come through the group assignment, right? So with that, I think we can wind up, unless you have any queries to further clarification on the this model of assignment, as well as on the areas that we discussed. No questions? Okay. So thank you very much, everybody, for taking part in this session. So we will meet up next week, Sunday. In the meantime, you will probably be contacted by IBSL on this grouping exercise. And if they need any additional information, please do submit such information immediately, because we need to know that for a better grouping mechanism, to have a better grouping mechanism, so that, diversified expertise will come into the group. Right. Okay then. Thank you.